Demystifying VIX ETFs, profiting from volatility or hype? Hey everyone, welcome back to Chat ETF. Today's topic might sound complex, but we're here to break it down. VIX ETFs. Ever heard of them? They're all about capturing market volatility, but are they the magic bullet some investors seem to think? We'll explore what VIX ETFs are, how they work, and if they can really help you profit from market swings. We'll also unveil some alternative strategies that might be a better fit for your portfolio, depending on your goals. So, buckle up and get ready to navigate the world of volatility with Chat ETF. Question 1. What is VIX ETF? Understanding VIX ETFs, not a direct measure of volatility itself. A VIX ETF, or Volatility Exchange Traded Fund, isn't a direct investment in the VIX itself, the Chicago Board Options Exchange Volatility Index. The VIX is a benchmark, often nicknamed the fear gauge, that reflects the market's expectation of volatility in the S&P 500 over the next 30 days. It's calculated based on options pricing, not directly tradable. Here's a breakdown of VIX and VIX ETFs. The VIX, this index measures anticipated volatility, not actual market swings. A high VIX suggests investors expect significant price fluctuations in the S&P 500 soon. VIX ETFs, these funds track various strategies to capture returns related to the VIX. They don't directly hold the VIX, but instead use instruments like VIX futures contracts. Why use VIX ETFs? Investors use VIX ETFs for two main reasons. Speculation on volatility. If you believe volatility will increase, a VIX ETF could provide profits as its price rises with the VIX. Hedging against downturns. VIX ETFs can act as a hedge against a falling stock market. When stocks go down, the VIX typically goes up, potentially offsetting some losses in your portfolio. Question 2. What is the VIX ETF's primary investment objective? The primary investment objective of a VIX ETF depends on the specific investor's strategy, but there are two main goals that attract most investors to these funds. 1. Profitieren van hoger volatiliteit, profiting from increased volatility. This is a speculative approach that aims to capitalize on periods of market turbulence. The VIX tends to rise when investors anticipate significant price swings in the stock market. By investing in a VIX ETF, the investor hopes to see the ETF's price rise in tandem with the VIX, generating a profit. 2. Absicherung gegen Marktdruck, hedging against market downturns. This strategy utilizes VIX ETFs for portfolio protection. The idea is that when stock prices fall, the VIX typically rises due to heightened volatility expectations. A VIX ETF can potentially offset some losses in the rest of the portfolio by appreciating in value during these periods. This creates a hedging effect, mitigating the overall portfolio decline. It's important to remember that VIX ETFs are not perfect hedges. The correlation between VIX and stock market downturns isn't always perfect, and other factors can influence VIX movements. Here's a breakdown of the key points. Primary objective: VIX ETFs cater to two main investment goals, profiting from volatility increases and hedging against market downturns. Volatility speculation aims for capital appreciation when the VIX rises due to anticipated market turbulence. Hedging aims to offset potential losses in a stock portfolio by potentially gaining from a rising VIX during market downturns. Additional considerations. VIX ETFs are complex financial instruments and may not be suitable for all investors, particularly those with a low risk tolerance or a long-term investment horizon. Due to factors like volatility decay, VIX ETFs are generally better suited for short-term bets on volatility rather than long-term investment strategies. Question 3. Does the VIX ETF employ any quantitative investment strategies? The answer to whether a VIX ETF directly employs quantitative investment strategies is a bit nuanced. Here's a breakdown. VIX ETF structure. VIX ETFs don't directly invest in the VIX itself, which is an index. Instead, they track various strategies to capture returns related to the VIX. These strategies often rely on futures contracts on the VIX, but not necessarily in a purely quantitative way. Quantitative versus non-quantitative strategies in VIX ETFs. Quantitative strategies, these rely on mathematical models and algorithms to analyze data and make investment decisions. Examples in the context of VIX ETFs could include using historical data and statistical models to determine the optimal timing for entering and exiting VIX futures positions. Employing option pricing models to identify undervalued or overvalued VIX futures contracts. Non-quantitative strategies, these involve more human discretion and judgment in managing the ETF. Examples for VIX ETFs might include a portfolio manager selecting specific VIX futures contracts based on their experience and market outlook. Actively managing the exposure to futures contracts to minimize volatility decay. The reality, a blend is likely. Many VIX ETFs likely use a hybrid approach, incorporating elements of both quantitative and non-quantitative strategies. The specific weight given to each approach can vary depending on the ETF provider's investment philosophy and expertise. Here's why a purely quantitative approach might not be ideal for VIX ETFs. Market inefficiencies. The VIX futures market might not always be perfectly efficient, and quantitative models may miss these nuances. Black swan events. Unforeseen events can significantly impact volatility, and a purely quantitative model might struggle to adapt. Human expertise. Experienced portfolio managers can use judgment to navigate complex market situations and adjust strategies as needed. Question 4. How frequently does the VIX ETF rebalance its portfolio? Unlike a typical index fund that tracks a basket of stocks, a VIX ETF doesn't rebalance its portfolio in the traditional sense of maintaining a specific target allocation. Here's why. Underlying holdings. VIX ETFs primarily hold futures contracts on the VIX, not actual stocks. These futures contracts have expiration dates. Continuous roll strategy. To maintain exposure to volatility, VIX ETFs employ a strategy called continuous roll. This involves selling expiring VIX futures contracts as they approach expiry. Simultaneously buying new futures contracts with further expiry dates. This process ensures the ETF tracks the VIX, which reflects the volatility for the next 30 days. Frequency of rolling. The frequency of rolling VIX futures contracts can vary depending on the specific ETF and its strategy. Here are some possibilities. Daily rolling. Some ETFs might roll contracts daily to maintain very close exposure to the nearest to expiry futures. Weekly or monthly rolling. Other ETFs might roll contracts weekly or monthly, considering factors like transaction costs and tracking efficiency. Essentially automatic. The rolling process is essentially automatic and driven by the expiry dates of the futures contracts. There's no set schedule or predetermined frequency for rebalancing a VIX ETF portfolio. Key points. VIX ETFs don't rebalance in the traditional sense due to their reliance on expiring futures contracts. The continuous roll strategy ensures ongoing exposure to volatility by replacing expiring contracts with new ones. The rolling frequency can vary depending on the ETF, but is driven by contract expiry and not a predetermined schedule. Additional considerations. While the rolling process is automatic, some ETFs might involve human intervention to manage the specific contracts being rolled. This could involve selecting contracts with specific expiry dates or strike prices to optimize the tracking efficiency or minimize costs. The frequency of rolling can impact the performance of a VIX ETF. More frequent rolling incurs higher transaction costs, while less frequent rolling might result in tracking errors. Question 5. How has the VIX ETF performed in different market conditions? VIX ETFs offer a complex relationship with market conditions. While they can be attractive for specific scenarios, understanding their performance across different market environments is crucial. Favorable conditions for VIX ETFs. Rising volatility. VIX ETFs tend to thrive when market volatility increases. As the VIX itself rises, so does the value of the ETF that tracks it. This aligns with the profiting from volatility objective. Market downturns. VIX ETFs can act as a hedge during market downturns. As stock prices fall, the VIX typically rises due to heightened volatility expectations. The VIX ETF's appreciation can potentially offset some losses in the overall portfolio. However, the effectiveness of this hedge can vary depending on the severity and duration of the downturn. Challenging conditions for VIX ETFs. Flat or low volatility markets. VIX ETFs struggle when markets are calm with low volatility. The VIX index dips in such scenarios, leading to a decline in the ETF's value. This can be detrimental to investors seeking to profit from volatility. Volatility decay. A major challenge for VIX ETFs is volatility decay. VIX futures contracts inherently lose value as their expiry approaches. This decay eats into the returns of VIX ETFs, especially if held for extended periods. Here's a breakdown of performance in different scenarios. Bull market. Rising stock prices. VIX ETFs might not generate significant returns, or even experience price declines, if the market experiences a prolonged bull run with low volatility. Bear market. Falling stock prices. VIX ETFs can potentially act as a hedge, offering some protection against losses in a declining market. However, the effectiveness of the hedge depends on the correlation between the VIX and the stock market downturn. Volatile market. VIX ETFs have the potential to shine in volatile markets. As the VIX fluctuates, the ETF's price can move accordingly, creating opportunities for profit for investors seeking to capitalize on these swings. Question 6. What are the key risks associated with the VIX ETF's investment strategy? VIX ETFs offer a unique approach to volatility, but their investment strategy comes with inherent risks. Here's a breakdown of the key ones to consider. 1. Volatility decay. This is the primary challenge for VIX ETFs. VIX futures contracts inherently lose value as they approach their expiry date. This time decay eats into the returns of a VIX ETF, especially if held for extended periods. Impact. Even if the VIX itself remains flat, the ETF's price can decline due to volatility decay. This can significantly erode potential profits or worsen losses. 2. Contango. Contango occurs when the price of a futures contract is higher than the spot price of the underlying asset, in this case, the expected future level of the VIX. Impact. When VIX futures are in contango, VIX ETFs need to buy new contracts at a higher price than they can sell the expiring ones. This creates a drag on performance. 3. Tracking errors. VIX ETFs don't perfectly track the VIX due to factors like expense ratios, rolling futures contracts, and potential deviations in the chosen strategy from the actual VIX movements. Impact. The ETF's performance might not perfectly mirror the VIX, leading to potential underperformance compared to the expected volatility movements. 4. Liquidity risk. Some VIX futures contracts, especially those with further expiry dates, might have lower trading volume. This can make it difficult for VIX ETFs to enter or exit positions quickly and efficiently, potentially impacting their ability to track the VIX. Impact: lower liquidity can lead to wider bid-ask spreads and difficulty in buying or selling futures contracts at the desired price. 5. Leverage risk. Some VIX ETFs employ leverage to amplify potential returns. However, this also magnifies potential losses. Impact: leveraged VIX ETFs can experience much larger price swings than the VIX itself, leading to significant and rapid losses during market downturns. 6. Short-term focus. VIX ETFs are better suited for short-term bets on volatility due to volatility decay and potential tracking errors that erode returns over longer periods. Impact: long-term investors might find VIX ETFs a poor fit for their goals due to the challenges mentioned above. Mitigating the risks. Investors can partially mitigate some risks by selecting VIX ETFs with lower expense ratios. Understanding the specific strategy and leverage employed by the ETF. Primarily using VIX ETFs for short-term volatility plays. Question 7. Are there other ETFs with similar objectives of VIX ETF, but lower expense ratios? Yes, there are a few alternative ETFs that share some similarities with VIX ETFs, but potentially offer lower expense ratios. Here's a breakdown of some options. 1. Short VIX ETFs. These ETFs aim to profit from decreases in volatility. They typically achieve this by using inverse exposure to VIX futures contracts. Lower expense ratios. Some short VIX ETFs might have lower expense ratios compared to traditional VIX ETFs, because their strategies can be simpler. Important considerations. Short VIX ETFs benefit from falling volatility, which can be the opposite of what a traditional VIX ETF aims for. Gearing your portfolio towards a short VIX ETF requires a specific market outlook, anticipating a decline in volatility. 2. Volatility managed futures ETFs. These ETFs offer a more diversified approach to volatility exposure. They may invest in futures contracts on various asset classes beyond the VIX, potentially including commodities, currencies, or even bonds. Potentially lower costs. Some volatility-managed futures ETFs might have expense ratios lower than traditional VIX ETFs, due to potentially simpler strategies or economies of scale from managing a broader basket of futures contracts. Important considerations. While offering some volatility exposure, these ETFs might not perfectly mimic the behavior of a pure VIX ETF. Their performance can be influenced by movements in the underlying asset classes they hold. 3. Option volatility ETFs. These ETFs focus on capturing returns from options premiums on various indices or stocks. They aim to benefit from increased volatility in the underlying assets, potentially offering some correlation to the VIX. Expense ratio comparison. Expense ratios for option volatility ETFs can vary depending on the specific strategy and complexity. Some might be lower than traditional VIX ETFs, while others might be similar. Important considerations. Option volatility ETFs might not directly track the VIX and can be influenced by factors beyond just overall market volatility. Understanding the specific option strategy employed by the ETF is crucial. Question 8. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, it's possible to achieve similar outcomes to a VIX ETF with a combination of individual stocks or other ETFs, potentially offering lower costs and greater control. Here's a breakdown of the possibilities. 1. Sector ETFs. Invest in ETFs that focus on sectors known to be more volatile, such as financials, biotechnology, or emerging markets. These sectors tend to experience larger price swings during periods of market turbulence. Benefits: potentially lower expense ratios compared to some VIX ETFs. More targeted exposure to specific areas of volatility you anticipate. Drawbacks: less diversified compared to a VIX ETF, which tracks volatility across the entire market. Requires research and selection of the right sector ETFs to align with your volatility expectations. 2. Inverse ETFs. Invest in inverse ETFs that track the opposite performance of a specific index or sector. For example, an inverse SP 500 ETF would rise in value when the SP 500 falls. Benefits: can potentially profit from market downturns, similar to how a VIX ETF might benefit during periods of rising volatility. Expense ratios of some inverse ETFs might be lower than VIX ETFs. Drawbacks: inverse ETFs can be complex and may not perfectly mirror the inverse movement of the underlying index. Requires a specific market outlook, anticipating a decline in the target index or sector. 3. Cash and fixed income ETFs. Allocate a portion of your portfolio to cash or fixed income ETFs like short-term bond ETFs. These tend to be less volatile than stocks and can provide stability during market downturns. Benefits: low expense ratios compared to most VIX ETFs. Offers a defensive strategy to hedge against potential losses in a volatile market. Drawbacks: limited potential for gains compared to a VIX ETF aiming to profit from volatility. Needs to be balanced with other holdings to achieve your overall investment objectives. Question 9. What are the pros and cons of this VIX ETF compared to similar options? The uniqueness of a VIX ETF's exposure depends on your investment goals and the specific alternative strategies you consider. Here's a breakdown to help you decide. Unique aspects of VIX ETFs. Direct volatility exposure. VIX ETFs offer a relatively straightforward way to gain exposure to market volatility expectations, specifically the volatility of the SP 500 over the next 30 days. This can be difficult to replicate precisely with individual stocks or other ETFs. Hedging potential. VIX ETFs can act as a hedge against market downturns. While not a perfect hedge, they can potentially offset some losses in a diversified portfolio when volatility rises. However, alternatives can achieve similar outcomes. Sector ETFs. While not a direct measure of volatility, strategically selecting sector ETFs in industries prone to high swings, e.g., financials, technology, can capture some volatility during market turbulence. Inverse ETFs. These can provide similar results to a VIX ETF during downturns. An inverse SP 500 ETF would rise when the SP 500 falls, mimicking the profit potential of a VIX ETF in a declining market. Cash and fixed income ETFs. These offer a defensive strategy, potentially mitigating losses during volatile periods. While not directly capturing volatility gains, they can act as a counterbalance to your overall portfolio exposure. Uniqueness versus control and cost. VIX ETFs offer a convenient way to access volatility exposure, but it comes with limitations like volatility decay and potentially higher expense ratios. Alternative strategies might require more research and active management, but can provide greater control over your portfolio's volatility profile and potentially lower costs. Alright everyone, that wraps up our deep dive into VIX ETFs. So, are they the ultimate volatility play? The answer, like most things in investing, is it depends. VIX ETFs offer a convenient way to get exposure to market volatility, potentially hedging your portfolio during downturns. But remember, they come with challenges like volatility decay and higher expense ratios. There are alternative strategies, though. Consider sector ETFs in volatile industries, inverse ETFs to profit from downturns, or even cash and fixed income ETFs for stability. You can craft a portfolio that captures volatility or protects against it, depending on your goals. The key takeaway? Understand your risk tolerance and investment goals. VIX ETFs can be a tool, but not the only one. Explore your options, and remember, consulting a financial advisor can always help you navigate the ever-changing market. Thanks for joining us on Chat ETF. Like this video if you want to see more breakdowns of complex investment topics, and leave a comment below letting us know what you think about VIX ETFs. Until next time, happy investing!